Well, I think we could start with, well, we'll talk about gold and silver. Everyone's focusing on the March contract. But with the February contract, which completely is gone in a couple of days, right? Like 3 days. As of yesterday, for February gold contract, right? There were still 4,366 contracts open. That's 436,600 ounces, or 13.5 tons of gold. Now, what's unusual about that, in fact, insanely unusual, is that it's insanely high, that number for this late in the cycle. In fact, it's 24 times normal. It's even bigger than the upcoming March contract, which I don't know if that's ever happened. That's a massive red flag. And really what it means, what most people would tell you it means, is a classic fingerprint of a big short that sold gold that they may not actually have to pay back. And if they were planning to buy it back, one would assume that they're somewhat trapped because liquidity is this late in the February contract is very thin. So normally when a contract goes off the board, like for example, the March contract goes off the board on Friday here, meaning it's time to either roll forward to probably the May contract, cash settle, or stand for delivery. And so when you see things this late into the February contract where there's that much gold that could stand for delivery that hasn't yet, it's very, 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 very unusual. And this is the kind of environment where, everything that the West has done for a long time is all about confidence. And for a long time, no one questioned the integrity or motivation of the West or of the United States, but that might be changing. And the moment the market believes that there isn't enough gold, the leverage that has really been the hallmark of this industry or of this platform unwinds. And when the leverage unwinds and commodities, moves become really violent. But I think it's also important to look at the more explosive brother or sister or cousin of gold, and that's silver. Let's start with the February contract again, because everyone's focusing on March, but I want to focus on the paper claims versus deliverable supply. It's important to understand that one COMEX contract equals 5,000 ounces of silver, right? We know that. And we've talked a lot about the deliveries. It's been really, as far as I'm concerned, all that people need to understand is that the biggest, most well-informed money in the world. In fact, since I met you, this is really what we've talked a lot about. I mean, we've talked about a lot of things, bricks and everything, but go back 5-6 years, we started talking about deliveries coming out of COMEX with the others, and it's been what we've focused on. Because the people that are standing for delivery in these quantities are well-informed, not just well-funded, very well-informed. And they know where the puck is going. Like Wayne Gretzky used to say, I don't skate to the puck, I skate to where it's going. And when you're spending 9 figures buying metals, in this case, every month, question needs to be asked, and the only question needs to be asked, who the hell is doing it? And where's it going? Now, the where's it going part, some people will debate. Well, a lot of it stays in COMEX, Andy. They'll say, okay, some of it does. That's called the eligible category, where it could be sold if wanted to be sold, but it doesn't want to be sold. I've mentioned how we have 8 Brinks facilities throughout the country. One is in New York City. That is a Brinks facility. A COMEX facility. Of the 8 Brinks facilities we have in North America, one is COMEX. It's Brinks JFK. And I have lots of clients in there that, and you probably do too, that have 1,000-ounce bars inside of the eligible category. They're not for sale, and they're not backing the bars that are listed on the COMEX exchange right now, although they could be if they wanted to. Anyways, so we've seen in February 4,639 contracts delivered. That equals, what does that equal? 23,195,000 ounces of, this is silver, by the way, excuse me, 23,195,000 ounces of silver. So 4,639 contracts times 5,000 ounces is 23,195,000 ounces. Okay, so that's about the low end of what we've seen since a year ago, November, every single month. Every single month it's been between typically 30 and 70 million ounces that stand for delivery. So that's a big deal, right? But here's a bigger deal. So while we have seen 23,195,000 ounces stand for delivery, in the month of February, we have seen 38,082,934 ounces leave COMEX. Leave. Now, if I keep saying this to put it in perspective, if a mint box of Silver Eagles weighs 42 pounds for 500 ounces, who took possession of 38,082,934 ounces? How many semi-trucks is that? And where is it going? And so I would say to you, the people that are doing this understand where the puck is going. The people that are spending this kind of money and withdrawing it out of the ecosystem, where the vault withdrawals are 164% of the February delivery demand so far, that means more metal is being pulled out than delivery alone can explain. This is highly unusual, highly. Let's talk about the March contract. Now, I haven't updated it over the last 2 days, but a couple of days ago, there was still 47,847 contracts in silver outstanding, with 4 days left till it comes off the board. That's 239.2 million ounces of silver. In contrast, the total registered silver inventory, that is the category of metal specifically earmarked for physical delivery, stands at 88 million ounces. What this is a paper Ponzi scheme, and it's a looming game of musical chairs. If even half of that open interest actually decided to stand for delivery, that's 120 million ounces with only 88 million ounces in registered. Do you see how that becomes a massive, massive problem?
Let's start with gold, because everyone's obsessed with the March contract, but the February contract is where the real fireworks are happening right now. And I want you to really think this through with me, because this isn't normal. This isn't business as usual. This is the kind of thing that makes seasoned traders sit up straight. As of yesterday, with just a few days left before the February gold contract goes off the board, there were still 4,366 contracts open. That represents 436,600 ounces of gold, roughly 13.5 metric tons. Now, on the surface, that might not sound dramatic, but context is everything. This number is about 24 times normal for this late in the delivery cycle. 24 times. In fact, it's even bigger than the open interest in the upcoming March contract. I don't know if I've ever seen that before. When a contract is about to expire, liquidity dries up. Participants have already rolled forward to the next month, cash settled or stood for delivery. What you don't see is thousands of contracts still sitting there, like unexploded ordnance. That is a massive red flag, because what it typically means is that someone sold gold, a big someone, and hasn't bought it back. And if they were planning to buy it back, they're now cornered. Liquidity is thin this late in the cycle. If you try to cover in size, you move the market violently against yourself. So the question becomes, is there a large short trap? And if there is, what happens next? You see, for decades, the Western gold market has operated on confidence. Leverage works only when people believe the metal will be there if called upon. But when open interest late in a contract balloons to 24 times normal, that's the market whispering. Something's off. Confidence is everything. And when confidence wobbles in a leveraged market, commodities don't move gently. They move violently. Now let's pivot to silver, because as I often say, silver is gold's more explosive sibling. Gold walks, silver sprints. Gold whispers, silver screams. One COMEX silver contract equals 5,000 ounces. That's important because numbers in this market get big quickly. In February alone, we've seen 4,639 contracts delivered. Multiply that by 5,000 ounces per contract, and you get 23,195,000 ounces of silver. That's just February. Now here's what matters. That 23 million ounces is actually on the low end of what we've seen in recent months. For over a year now, deliveries have consistently ranged between 30 and 70 million ounces per month, month after month after month. That's not retail coin collectors. That's not hobbyists. That's institutional money. And this is where I want you to remember something Wayne Gretzky said. I skate to where the puck is going, not where it's been. When someone spends 9 figures every month taking delivery of physical metal, you have to ask, who is doing it and where is it going? Some of it stays inside the COMEX ecosystem in what's called the eligible category. Eligible means it's in the vault but not registered for delivery. It could be sold, but it isn't. And I can tell you from firsthand experience, many of those bars sitting in eligible aren't for sale. I have clients with thousands of bars in Brinks JFK, which is both a Brinks facility and a COMEX vault. They're not backing paper contracts. They're not moving. They're parked. Now here's the part that should really make you pause. In February, We saw 23 million ounces delivered, but we saw 38,822,934 ounces leave COMEX vaults entirely. Let me repeat that. Almost 39 million ounces withdrawn. That means vault withdrawals are 164% of February's delivery demand so far. In plain English, more metal is leaving the building than delivery alone can explain. If a mint box of 500 Silver Eagles weighs about 42 pounds, imagine how many semi-trucks you need to haul nearly 39 million ounces. Where is it going? That's the question that matters. And now let's talk about March. A few days ago, there were still 47,847 contracts open for March silver, with only 4 days left before the contract goes off the board. Multiply that by 5,000 ounces per contract, and you get 239.2 million ounces of silver in open interest. In contrast, the total registered silver inventory, the metal specifically earmarked and available for delivery, sits around 88 million ounces. Let that sink in. 239 million ounces in paper claims, 88 million ounces registered. That's a ratio that would make even a Las Vegas casino blush. Now, does that mean all 239 million ounces will stand for delivery? No. Historically, only a fraction does. Most contracts roll forward or settle in cash. But here's the problem. If even half of that open interest stood for delivery, that's roughly 120 million ounces. And there are only 88 million ounces registered. That's not a tight situation. That's musical chairs with more players than chairs.
So I think when you talk about where the metal is moving, whether it be standing for delivery here or the continued arbitrage that we see in Shanghai, where the silver price has been between $10 and $20 an ounce more than in the West, enticing arbitrage. Normally, an opportunity like that doesn't last very long as the sophisticated traders capitalize on that arbitrage. But when you realize that it is staying strong, that tells you that the Chinese are saying, look, we're choking on dollars. The dollars are not worth as much as the silver. Keep the arbitrage, keep that higher premium so that you get the traders who will buy 20 million ounces in the West and deliver it in China. Typically, there's a COMEX contract that goes right to Hong Kong where a Brinks truck would pick it up or a truck would pick it up and bring it to Shanghai. At a $20 or $15 or $20 an ounce premium on 20 million ounces, you're making enough to change your life 10 times over. And are they doing it? Sure. And it's not even that premium that they're paying, the Chinese are paying to buy that. On top of that premium, there's a VAT tax. That VAT tax is not the responsibility of the exporter into China. It is the responsibility of the recipient when it leaves the Shanghai Metals Exchange. They will be charged a VAT tax. So they're willing to pay a 13, 14, 15% VAT tax and a 13 or 14, $15 premium on top of that to entice the Western traders to send it. That tells you where the real value of silver is, and the movements and the mechanics and everything we've seen so far in terms of price to the downside in many respects is contrived through raising margin requirements, through trying to squeeze the speculators out. And you can see that by the open interest, which is falling considerably. It worked. It did. And that metal then has moved into the strong hands who don't use margin, who I would venture to say over the next several days plan on standing for delivery in huge amounts. And now that Shanghai is open today and you see the price down a little bit, it's interesting as we get right to the end of the delivery cycle. This is what they're going to do again, where we saw before the price got hammered. Not only did JP Morgan cover almost 800 contracts at the very, very, very bottom. Interesting how they did that. But how about SLV? During Silver Squeeze, SLV said BlackRock amended the prospectus, I think, on a Saturday night. And they said there's such inflow coming and there could be a lag between the time that we indeed confirm this as a good trade and when the shares are issued, because it's coming so fast and there could be a discrepancy there. Shares are issued when the metal is deposited into the exchange. So right before the market collapses, it's at $115, $120 an ounce, record volume into SLV. It collapses, and right at the bottom, guess what? 38 million ounces of silver are deposited into SLV by an authorized participant at the bottom where the shares are created. Does it seem interesting that they sell it up here, they deposit it down here, and then the metal moves from the COMEX into the SLV vaults that are institutionally controlled by those commercial banks that issue the shares, and they continually do what's called share redemption and stand for delivery on metal inside the SLV ecosystem and GLD.
Now let's take this a step further, because this is where things get very serious and very interesting. When you have 239 million ounces of silver in open interest against 88 million ounces registered, you're staring at a leverage structure that only works as long as most participants don't demand delivery. The system is built on the assumption that futures are for price discovery, not for metal acquisition. But what happens when that assumption changes? What happens when more and more players say, "No thanks, I'll take the metal"? That's when the entire dynamic shifts. The COMEX is not designed to handle mass physical withdrawal. It's designed to facilitate hedging and price discovery. The registered category is the metal specifically earmarked for delivery. The eligible category is metal that could be delivered, but belongs to someone who has not made it available. And that distinction matters, because when someone owns bars ineligible, they own them. They're not for sale unless that owner decides to sell. You can't just tap them on the shoulder and say, "Hey, we need those bars to settle a short position." It doesn't work like that. So when you see vault withdrawals that exceed delivery demand by 164%, you're witnessing something that delivery reports alone don't explain. Metal is leaving the system, and metal leaving the system reduces flexibility. Flexibility is everything in a leveraged environment. Now imagine even 20% of that March open interest decides to stand. That's roughly 48 million ounces. That alone would consume more than half of registered inventory. You don't need a full-blown default to create stress. You just need enough demand to force the exchange into defensive maneuvers. And what do defensive maneuvers look like? They look like widened exchange for physical spreads. They look like incentivized cash settlements. They look like quiet phone calls offering premiums to roll forward. This is how stress manifests, not necessarily with fireworks. Sometimes it's subtle, but when you're watching the plumbing, you can see it. Now let's connect this to gold, because gold is the foundation. The February gold contract's open interest anomaly, 24 times normal this late, suggests something even more delicate. Gold is the monetary anchor. If there's stress in gold delivery, that's not just a commodity issue, that's systemic. For decades, gold's paper leverage has been enormous. Some estimates suggest 50 to 1 or even 100 to 1 paper claims relative to physical. That leverage works as long as delivery demands remain modest. But if confidence shifts, if foreign central banks, sovereign wealth funds, or major institutions begin demanding allocation and repatriation, the leverage unwinds. And when leverage unwinds in commodities, the move is not incremental, it's explosive. Look at history. In 1971, when the US closed the gold window, it wasn't gradual, it was sudden. Confidence snapped. In 2008, when financial leverage unwound, markets didn't drift down, they collapsed. In March 2020, liquidity evaporated almost overnight. Confidence-based systems fail quickly once trust erodes. And right now, the geopolitical backdrop is not supportive of blind trust. You have trade wars, sanctions, reserve asset weaponization, central banks accumulating gold at the fastest pace in modern history. You have China maintaining a persistent silver premium, effectively signaling a different valuation framework than the West. These are not isolated events. They are connected. The West operates on credit. The East increasingly operates on collateral. Gold and silver are collateral. When you see tens of millions of ounces withdrawn month after month, you're witnessing collateral migration. And here's something else to consider. Industrial demand for silver isn't shrinking. Solar panels, EVs, electronics, military applications. Silver is embedded in modern infrastructure. The supply side is constrained. Most silver is a byproduct of mining other metals. You don't just flip a switch and produce more silver because price rises. That's a structural supply limitation, so you have rising monetary demand layered on top of inelastic industrial supply. That's not a bearish combination. Now, does that mean the price only goes up? Of course not. The exchanges can and will use volatility to shake weak hands. Margin hikes are powerful tools. Synthetic sell-offs can create fear. But here's the difference between now and 5 years ago. The withdrawals are persistent, the deliveries are persistent, the Eastern premiums are persistent, and that persistence tells you something. This isn't a one-off squeeze. It's a gradual reallocation. Now let's talk about the bigger elephant in the room, the dollar. The dollar remains dominant, for now, but dominance erodes at the margins. It doesn't collapse overnight. It loses ground gradually, then suddenly. Foreign buyers of treasuries have been net sellers in various periods. Central banks are diversifying reserves. If long-term rates remain elevated, even as the Fed attempts to ease, the Fed will be forced into a difficult position. If they monetize debt more aggressively, gold benefits. If they don't, debt servicing costs strain the fiscal framework. Either way, gold becomes more relevant, and silver, because of its smaller market and dual-use nature, becomes more volatile. Now let's circle back to that paper Ponzi scheme phrase. Is COMEX literally a Ponzi scheme? No, it's a futures market, but it is built on fractional backing. It assumes most participants don't demand the underlying asset. That assumption is being tested, and the test doesn't need 100% participation to create disruption. It needs enough participation to expose fragility. The game of musical chairs doesn't require everyone to stand at once. It only requires more players than chairs when the music stops. And right now, there are clearly more paper claims than registered chairs. So what does this mean for you? It means don't get distracted by day-to-day price swings. It means understand that the biggest, best-informed money in the world is accumulating physical metal. It means recognize that when someone spends 9 figures every month withdrawing metal from the system, they are not guessing. They are positioning. You don't have to believe in conspiracy theories to see structural imbalance. The data is public. Open interest versus registered inventory, vault withdrawals versus delivery demand, persistent Eastern premiums versus Western pricing. These are objective numbers, and objective numbers tell a story. We are approaching a point where leverage meets physical reality. Maybe it resolves quietly with higher prices and gradual adjustment. Maybe it resolves violently with a short squeeze or delivery crunch. I don't know the timing, but I know this. Systems built on confidence and leverage are stable until they aren't. And when the most informed participants are pulling collateral out of the vaults month after month, that's not something you ignore. You pay attention. Because as Wayne Gretzky said, you don't skate to where the puck is. You skate to where it's going. And right now, the puck is moving toward physical scarcity, Eastern price discovery, and a revaluation of monetary metals in a world drowning in paper promises. That's the signal.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.